Welcome to the Deep Dive. We're here to sift through the source materials you provide, pull out the core knowledge, and basically give you the shortcuts to being genuinely well-informed.
That's right.
And today, we're tackling a really interesting one, a bit of a paradox, actually. B&M, European Value Retail.
BME on the London Stock Exchange.
Exactly. A UK discount giant that, well, has built this incredibly explosive growth story over the last decade. Seriously impressive compounding.
Yeah, phenomenal numbers.
But, and here's the paradox, until very recently, its stock was trading like, well, like it was on its last legs.
It's a fascinating disconnect. So our mission today is to really dissect B&M. It's a company that blends, the resilience you expect from a value retailer with the growth of a fast expanding leader.
And crucially, the sources we have are right up to date.
They cover management updates from October 2025, so you're getting a really current snapshot.
Right when the company's navigating big leadership changes and a pretty significant operational reset.
An inflection point, really.
Yeah. So let's dive into those big numbers first, because they really set the stage for why this demands a deep dive. The disparity here is just striking.
It really is. I mean, you look back over the last 10 years, this company has been an absolute machine. The sources show revenue compounding at, 14.7% annually?
14.7%. That's huge for retail over a decade.
It is. But even better is the diluted earnings per share. That compounded at 27.0% annually.
27%.
Yeah. I mean, find me another major retailer globally that's matched that kind of bottom line growth consistently. It's an engine.
And they do it efficiently, too, that operating margin.
Consistently over 10%, which for a discount model is really, really healthy. But here's the kicker, the stat that really made us think, okay, we have to cover this.
Go on.
Between fiscal 21 and fiscal 24, so just 4 years, B&M distributed $1.8 billion in dividends.
$1.8 billion, including specials, right?
Including large special dividends, yeah. Now, put that in context. At the time this analysis was done, the company's entire market cap was only about 2.7 billion pounds.
Wait, so in 4 years, they paid out dividends equal to 2/3 of their market value?
Pretty much, yeah, 2/3. It tells you this business generates cash way, way faster than it needs for reinvestment. It's just throwing it off.
Incredible. And yet,
despite this track record, this proving ability to compound wealth and shower shareholders with cash, the stock recently hit some really low valuations.
like what?
We're talking a price-to-earnings ratio of about 8x and price-to-free cash flow down around 5x.
Wow, that's deep value territory for a company with that kind of history.
Exactly. So that's the core tension, right? The huge disconnect between the historical performance, the cash generation, and how the market was pricing it very recently.
So let's unpack it. Let's get into the fundamentals that built this giant in the first place.
Right. Let's start with segment 1, B&M's core identity and this high-growth variety discount model they run.
Okay, so this isn't some new startup. It dates back to 1978.
A long history. But the real story, the transformation, that kicks off in 2004.
Right, when the Aurora family acquired it.
Yeah. They took what was then a pretty small chain, just 21 stores, and they just scaled it relentlessly.
And the scale now.
As of March 2024, it was over 1,100 locations across the UK and France.
Over 1,100. Wow. How does that break down?
So you've got the main engine, 741 B&M UK stores. Then there's Heron Foods, which is 335 convenience stores, and 124 stores under the B&M banner in France.
Okay, and they operate this variety discount model. What does that actually mean in practice?
It means it's basically a one-stop shop for, almost anything discounted. One source nicely put it as from hats and heaters to toys and food.
Okay. Covers a lot of ground.
It does. And the real genius in the model is the product mix.
The 50-50 split you mentioned earlier.
Exactly. Roughly half the sales are fast-moving consumer goods, FMCG, and the other half is general merchandise, GM.
Okay, break down why that balance is so important. Let's start with the FMCG side.
Right. So, FMCG. That's your everyday stuff. Dried foods, toiletries, cleaning supplies, things people buy regularly, week in, week out.
The essentials.
The absolute essentials. These might be lower margin items, but they guarantee footfall. They ensure people are constantly coming into the store.
So it provides a baseline.
Precisely. It acts as a floor for revenue, especially during economic downturns. People might cut back on discretionary spending, but they still need toilet paper and detergent.
And if B&M sells it cheaper than the supermarkets,
they keep coming. It makes the business incredibly resilient. That FMCG base is their insurance policy.
Okay, makes sense. And the other 50%, the general merchandise.
Right, GM. This is where you get the higher margins and, importantly, the excitement. household goods, DIY stuff, garden furniture, toys, seasonal ranges like Christmas decorations or back-to-school kits.
So this is the treasure hunt element people talk about.
Exactly that. You go in needing bleach, maybe some cheap biscuits, and you come out with a new rug, some garden gnomes, and maybe a discounted power tool you didn't know you needed. It drives impulse buys and boosts the overall basket value and margin.
And the customer base for this has shifted, hasn't it?
Massively. Traditionally, yeah, B&M was very strong with lower-income households. They served that demographic incredibly well.
But the cost of living crisis changed things.
Completely. Discount shopping has become, well, mainstream. It's lost any stigma it might have had.
So you're seeing wealthier shoppers.
Absolutely. The sources confirm this trading down effect is real and significant. Middle income, even higher income households, people earning over £100,000 a year, are now regular B&M shoppers.
Wow.
They're actively choosing B&M over traditional supermarkets or department stores because, well, being frugal is now smart. It's acceptable across the board.
So that strengthens them during tough economic times even further. They don't just keep their base, they actively gain share from rivals.
Exactly. It's a counter-cyclical boost baked right into their appeal. They win when times are good because they're cheap, and they win when times are bad because people need them to be cheap.
It's a powerful position. You also mentioned the multi-format strategy. Let's touch on that again.
Yeah, it's not just the main B&M UK stores, though they are the growth engine. The acquisition of Heron Foods in 2017 was really important.
Heron Foods.
Yeah.
They're more food-focused, right? Frozen and fresh.
Primarily, yes. Frozen, chilled, and ambient food. They're mostly based in the north of England, but acquiring them wasn't just about adding stores.
What else did it bring?
Crucially, it brought expertise in cold chain logistics, fresh food sourcing, handling things with short shelf lives. That knowledge has benefited the whole B&M group, making their FMCG offering stronger overall.
Interesting. And then there's France.
B&M France, yeah. They
Yeah.
bought a chain called Babou back in 2018, rebranded it. It took a little while, but it's now stably profitable.
And the potential there.
The sources suggest management sees the long-term potential in France as being similar in scale to the UK market.
Wow, so potentially another 700-plus stores just in France.
Potentially, yes. It's a huge, often overlooked growth runway for them. Adds another layer to the long-term story beyond just UK saturation.
Okay, so that's the model. Powerful stuff.
Oh.
Which leads us nicely into segment 2. How do they defend this? What's the competitive moat?
Right, because it is a competitive space.
Definitely. You got Home Bargains, Poundland.
And the big European player, Action, is expanding aggressively too. It's not like B&M has the field to itself.
No. But the discount variety sector is consolidating. And B&M's main weapon isn't some secret tech.
No, it's old-fashioned muscle. It's scale. Brute force scale and the buying power that comes with it.
How does that work in practice?
B&M's size lets them buy enormous volumes. Centralized buying, especially for that general merchandise stuff. They often go direct to manufacturers, bypassing middlemen, particularly sourcing heavily from Asia.
Ah, direct sourcing, so they cut out cost.
Big time. It gives them incredibly favorable terms, much better than smaller competitors can get. And that purchasing clout lets them maintain what they call the price gap.
Meaning they can consistently undercut rivals.
Yeah. They can reliably sell branded goods, remember? Half their mix is FMCG brands people recognize, often cheaper than supermarkets sell their own label alternatives for. That's a powerful value proposition.
And the low-cost operations feed into that too.
Absolutely. It's the other side of the coin. The stores are deliberately no frills.
You see that when you go in, basic fit out.
Exactly. They favor low-rent retail parks, not expensive high streets. That keeps initial fit-out costs down and ongoing rents manageable. It minimizes operational complexity.
And that philosophy runs through the whole company.
It seems so. Management explicitly targets low corporate overheads, simple processes. It creates this self-reinforcing loop or flywheel.
Right.
Low costs allow low prices. Low prices drive high sales volume. High volume increases their buying power, which lets them lower costs further or improve margins or both.
A virtuous cycle of cheapness.
Pretty much. And it's how they sustain those 10% plus operating margins while still being perceived as offering rock-bottom prices.
Then there's the customer experience side, that treasure hunt.
Yeah, that's crucial for driving repeat visits and impulse buys. It's not just the staples. It's the constant rotation of seasonal goods, the closeout deals, the one-off special buys.
You feel like if you don't buy it now, it'll be gone next week.
Exactly. That sense of scarcity and novelty mixed in with the predictable branded stuff is psychologically very effective. It makes shopping there feel a bit like, well, a treasure hunt.
And they're opportunistic too. The Wilco example you mentioned earlier.
Textbook opportunism. Wilco, a major high street competitor, went bankrupt in 2023. Chaos for them. Opportunity for B&M.
What did B&M do?
They moved fast. They cherry-picked 51 of the best Wilco store leases out of administration, and they paid just £13 million for them.
$13 million for 51 stores. That's peanuts.
Incredible value. It wasn't just cheap property, it was strategic. They took over prime locations, eliminated a competitor, and accelerated their own store rollout plans significantly, all at minimal cost.
Did they keep the staff?
Yeah. They hired over 2,100 former Wilco employees. Seamless integration really showed their operational strength and financial health. They could act decisively while others were struggling.
So the strength of this whole model, the scale, the low costs, the opportunism.
Yep.
How does it show up in the financial metrics? You mentioned ROIC.
Return on invested capital. It's the acid test for how efficiently a company uses its money. And B&M's ROIC, if you exclude goodwill from acquisitions, is consistently over 30%.
30% plus. How is that even possible for a retailer, especially a discount one?
It boils down to the capital light model. Remember, they lease their stores, they don't own them.
Ah, right. So they don't have billions tied up in real estate.
Exactly. Their investment is mainly in fitting out the store, the inventory, and working capital. That's much less capital than owning the land and building. And because new stores become profitable very quickly, the payback period is less than a year.
Under a year, wow.
Yeah, or even just 9 months if you strip out the initial working capital investment. So they deploy relatively little capital and get a high profit back very fast. That's what drives such a high ROIC.
That explains why they're called a compounding machine. High returns mean profits can be reinvested to generate even more profit.
Or return to shareholders, which they do aggressively. And that high ROIC directly translates into massive cash generation.
Perfect segue into segment 3, financial strength and cash generation. Let's look at that cash engine.
Right. The profitability is solid, as we said. Fiscal year 2024, they hit $5.48 billion in revenue.
Now the profit.
Adjusted operating profit was $614 million, so that margin held up around 11.2%. Adjusted EBITDA was $629 million. Good numbers.
But the cash flows are the real story.
Absolutely. Because the model is asset light, the profits convert into cash incredibly well.
You gave that huge 4-year figure earlier.
Yeah. $3.3 billion in cumulative operating cash flow from FY21 to FY24. Just phenomenal.
And in the latest year, FY24.
Post-tax free cash flow, so cash left after tax, interest, and funding investments, was $382 million.
$382 million free cash flow.
Yeah.
And that's after paying for new stores and upkeep.
Exactly. Because the cost of maintaining the existing store base, the maintenance capex, is actually very low.
How low?
The estimate is only 50 to 70 million pounds a year, which is tiny relative to revenue, maybe 1.2%.
So nearly all the earnings become spendable cash.
That's the high cash conversion story. It just pours out.
And we know they don't hoard it. You mentioned the $1.8 billion in dividends.
Yeah, their capital allocation policy is very clear and very shareholder friendly.
What's the priority order?
First, reinvest in high return organic growth, opening those profitable new stores. That comes first.
Makes it.
Second, pay a regular ordinary dividend. They target paying out 30-40% of net income.
Okay, sustainable.
And then, crucially, any cash left over after funding growth and the ordinary dividend, what they deem excess cash, gets returned via special dividends.
And that $1.8 billion shows they really mean it with the special dividends.
They absolutely do. It signals huge confidence from management in the ongoing profit stream. They don't feel the need to build a giant cash hoard just in case. They trust the model to keep generating.
That implies a pretty safe balance sheet then. What about debt? How does a company growing fast and paying huge dividends manage debt?
Sensibly, it seems. They aim for a net debt to EBITDA ratio, excluding leases, of between 1 and 2 times.
And where were they recently?
As of March 2024, comfortably at the low end, around 1.2x, so moderate leverage.
What's the total debt level?
Gross debt was around $919 million. But the key is the structure. They've managed the maturities well.
Meaning no big repayment crunch coming up.
Exactly. They've staggered the debt, pushing maturities out as far as 2030. No near-term refinancing cliff to worry about.
Okay, but I think there was a new bond issue mentioned in the sources with a higher interest rate.
Yeah. In 2023, they issued a new bond paying 8.125%.
8%. Sounds high.
Well, it reflects where interest rates were for corporate borrowing in 2023-24. It wasn't cheap for anyone. But B&M can easily handle it.
Why is that?
Because their earnings are so massive relative to the debt. Interest coverage EBITDA compared to interest payments is over 10 times. Robust.
Even paying 8% on some of the debt is easily manageable within their cash flow.
Comfortably. The balance sheet is strong enough to fund the growth, pay the dividends, and service the debt without any stress.
Got it. And one last point on structure of this redomiciliation plan, moving the parent company from Luxembourg.
Yeah, the plan is to move it to Jersey or Ireland.
Why bother? What's the benefit for investors?
Two main things, really. Simplification and efficiency. Admin gets easier. But the big potential win is eliminating the 15% Luxembourg dividend withholding tax.
So shareholders, especially big international ones, would get more of the dividend payment directly.
Potentially, yes. A direct boost to post-tax returns for many. It also apparently gives the company more flexibility legally for things like share buybacks in the future.
So reinforcing that shareholder return focus.
Exactly. It's all consistent with that theme.
Okay. So financially strong, operationally efficient, great track record. You'd expect smooth sailing.
You would. But B&M hit some turbulence recently, which brings us right to segment 4, the leadership change and this back-to-basics reset.
This feels like the crux of the recent stock price weakness.
It absolutely is. This is the narrative tension. There's been significant churn at the very top.
Right. The founder, Simon Arora, retired. When was that?
He stepped down in 2022. Then Alex Russo, who had been the CFO, took over as CEO.
Okay. Internal promotion seems stable.
But then in February 2025, Russo announced he was retiring, effective April 2025. He only lasted about 2.5 years in the top job.
2.5 years. That's a very short tenure for a CEO.
It is. And that kind of quick turnover inevitably signals uncertainty to the market. Questions get asked. Why is he leaving so soon? Is there an issue?
Regardless of the underlying business quality.
Exactly. So the new CEO, Tjeerd Jagen, took the helm in June 2025. The big question was, what did he find when he lifted the lid?
And he commissioned a review straight away.
An immediate comprehensive review. And his findings, which he shared in the October 2025 update, were surprisingly blunt.
What was the diagnosis?
He essentially said, look, B&M's core value proposition being cheap, relevant, offering that treasure hunt that's still strong, people still want what B&M offers.
Right.
But the operational execution had weakened. It had drifted, as he put it, in recent years. The basics weren't being done consistently well.
And that drift was showing up in the numbers.
Starkly. The most recent results for the first half of fiscal 26 showed group revenue was up 4.0%.
Yeah.
Okay, it's still all right.
But that was just new stores opening.
Entirely driven by new stores. The critical metric like-for-like sales growth in the core B&M UK business sales from existing stores was basically flat, just plus 0.1%.
Ouch. Flat LFL is not good for growth retail.
It's worse. Within that half, the second quarter LFL actually declined by 1.1%.
Negative like-for-likes. That's the real red flag, isn't it?
It absolutely is. For any retailer, but especially one like B&M that relies on operating leverage, spreading fixed costs over growing sales. Flat or negative LFLs are damaging. It erodes margins, stalls profit growth. It suggests they're losing ground or not getting the most out of their existing assets.
So Geoghegan identifies this drift, sees the negative LFLs. What's the plan?
The Back to B&M Basics plan, a very clear, focused strategy to fix the execution in 4 core areas where things had slipped.
Okay, let's break those down. What's the first area?
Price.
What?
Sounds obvious for a discounter, right? But they realized they'd lost some sharpness.
How's it?
While the overall basket price might still have been competitive, the pricing on individual high-profile items, what they call key value items or KVIs, wasn't always consistently the sharpest.
So the items people use to judge the whole store's value, like the price of a specific brand of coffee or detergent.
Exactly. Those price anchor items. If they weren't demonstrably cheap, it could hurt the overall perception, even if the total shop was still good value.
So what's the action?
Immediate action. They're cutting prices on 35% of those KVIs.
35% of them. That sounds like it could hit margins.
It will have a small impact, yes. The average price cut on those specific lines is 1.8%. But they see it as essential investment to restore that absolute price credibility, resharpen the value message.
Okay, price is number 1. What's number 2?
Availability. This one sounds like basic retail blocking and tackling, but they found significant issues.
Stock on the shelves.
Exactly. Product availability, particularly for the best-selling FMCG lines, the stuff people really come in for, was running at only 86%.
86%. What should it be?
Best-in-class retailers aim for and achieve closer to 98% availability on key lines.
So 12% points below best practice. That's a massive gap. Means customers are leaving empty-handed nearly 15% of the time for popular items?
Effectively, yes. It's lost sales and potentially lost customer loyalty if it happens repeatedly, and the review found why it was happening.
Go on.
Apparently, the previous operational focus had been heavily on store standards, making the shelves look full and tidy for visual merchandising.
So presentation over substance.
In a way, yes.
Yeah.
That focus on appearance, on having a full shelf look, sometimes came at the expense of actually having the right stock, the high-demand items, available for purchase. They were prioritizing how the store looked over its core function of selling things people wanted.
Wow. Okay, how are they fixing that?
Shifting the focus immediately. Implementing best practice replenishment processes. Rigorous weekly checks on actual availability of core lines. The priority is now ensuring the right products are in stock, not just making the shelves look pretty.
Makes sense. Third area of drift.
Range. This is about complexity creep.
Too many different products.
Exactly. Over time, without strict discipline, the number of different SKUs stock-keeping units had just ballooned. By April 2024, they had 16,500 different live product lines.
16,500. That sounds incredibly complex to manage.
It is. It leads to higher sourcing costs, more complex logistics, inefficient use of shelf space, more staff time needed for restocking, and inevitably, more old, slow-moving stock building up.
So the plan is simplification.
Yes. Ruthless simplification, reducing SKU complexity, getting rid of the long tail of slow sellers, accelerating clearance of old inventory.
What will they focus on instead?
Especially in FMCG, the focus will be on the major, well-known brands that customers recognize and trust. Fewer, better choices, makes the shop easier, makes the supply chain cleaner, reduces costs.
When will we see this?
The first pilots focusing on specific categories are expected to be visible in stores by the end of 2025. It's a phased approach.
Okay. And the fourth and final area.
Promotions. Remember the treasure hunt?
Yeah, the excitement, the special buys.
Well, that had apparently gone a bit stale. The manager specials, often found at the front of the store, had become too static, too predictable, maybe not relevant enough.
Lost its sizzle.
Lost its sizzle, exactly. The action here is to properly rejuvenate those key promotional areas.
How?
Making the offers genuinely exciting again, tightly linked to seasons. Think back to school, Halloween, Christmas, and importantly, introducing more localization.
Letting local store managers have more say.
Within a central framework, yes. Giving them more flexibility to choose the specific promotional lines that they know will resonate best with their local customer base. Trying to reignite that impulse buy excitement.
Okay, so price, availability, range, promotions. A pretty comprehensive back-to-basics plan.
It is, and acknowledging these weaknesses publicly and the cost of fixing them led management to revise the financial guidance for the current fiscal year, FY26.
Lowering expectations.
Yes. The new adjusted EBITDA guidance is a range of $510 million to $560 million. That's down from what the market might have hoped for previously.
But the message is, this is the new floor.
That's exactly how they're positioning it. This revised range is the baseline, the foundation from which they intend to rebuild sustainable like-for-like growth.
And it won't happen overnight.
No, they're guiding that the full benefits of this back-to-basics push will likely take 12 to 18 months to flow through completely. It requires embedding new processes, changing habits.
Still, despite the short-term pain and uncertainty, you mentioned insider confidence.
Yeah, that's a really interesting signal. In the wake of this update and the reset guidance, several board members, including the chair, Tiffany Hall, were reported buying B&M shares on the open market.
Buying with their own money.
Yes. And importantly, at prices above where the stock was trading at its absolute lows.
That's a strong vote of confidence, isn't it? Suggests they truly believe the plan will work and the company is undervalued.
It certainly implies conviction in the recovery strategy and the fundamental long-term value proposition. Actions speak louder than words.
Absolutely. So let's remind ourselves why fixing these basics matters so much. Let's look beyond the immediate challenges and revisit the long-term picture in Segment 5, the growth runway and long-term potential.
Right, because despite this operational wobble, the underlying growth story for B&M remains potentially huge. It's built on 4 clear pillars.
Pillar 1 must be fixing that LFL performance.
Absolutely. LFL sales recovery in the UK. We saw how damaging flat or negative LFLs are. But the flip side is, getting back to positive LFL growth is incredibly powerful and capital efficient.
How efficient?
The sources estimate that every 1% improvement in UK LFL sales growth delivers roughly the same profit uplift as opening 7 brand new average-size stores.
Wow. without the cost of building them.
Exactly. It flows straight through because the cost base is largely fixed.
Hmm.
So if Jagan's plan works and gets LFLs back into that historical 3–5% positive range, it's a massive profit lever.
Okay, LFL recovery is key. Pillar 2.
Pure physical expansion, UK store expansion. And they've actually raised their long-term target here.
Raised it. From what to what?
The old target was 950 B&M UK stores. The new revised target is at least 1,200 stores.
1,200. Compared to the 741 they had in March 24.
Yeah, it implies a further 62% increase in the UK store base from that point. It's a massive runway still ahead just in their home market.
And they have concrete plans to get there.
Yes. The plan is to open 45 gross new B&M UK stores per year for at least the next 3 fiscal years, FY25, FY27. A steady, predictable rollout.
And we know this growth is cheap because they lease.
Exactly. The capital expenditure for fitting out a new store is low, around £760,000 per store in FY24 numbers.
And easily funded internally.
Totally. Remember that $382 million free cash flow in FY24. That covered the total capex bill of $124 million, nearly 3 times over. Growth is not capital constrained here at all. It pays for itself.
Okay, UK LFL recovery, UK store expansion. Pillar 3.
B&M France. We touched on this. Currently 124 stores, but management sees potential comparable to the UK market size.
So huge potential upside. What's the rollout plan there?
They're aiming to ramp up openings to between 15 and 25 new stores per year in France. The long-term goal is also to get the profit margins in France closer to the UK levels as they build scale.
Makes sense. And the final pillar.
Heron Foods, convenience food chain.
What's the plan for Heron?
Steady expansion here too, targeting 20 new store openings annually. But the really interesting part is the ambition to expand beyond its traditional Northern England base.
Taking it nationwide.
Potentially. The market leader in that UK convenience frozen food space has over 2,000 stores. Heron has just 335. There's enormous white space for them to grow into if they can successfully expand geographically.
So 4 distinct, significant growth avenues is quite compelling.
It is, but we have to balance that with the risks, of course.
Right. What are the main ones highlighted?
Well, intensifying competition is definitely one. We mentioned Action expanding in Europe. Home Bargains is a strong UK competitor. They can't afford to be complacent.
Well, e-commerce.
Yeah, the e-commerce disruption question hangs over them. B&M currently has a minimal online presence.
Why is that?
Their argument is that their average basket value is relatively low, and many items are bulky or low-priced, making the economics of online ordering and delivery very challenging. Profitable home delivery for £1 items is hard.
It's a fair point, but could it become a vulnerability long-term?
It could. Consumer habits change. It's a potential risk they need to keep monitoring. Then there are always supply chain and FX risks, especially given their heavy sourcing from Asia. Currency fluctuations or shipping disruptions can impact costs.
But offsetting those risks is their inherent resilience.
Yes, the countercyclical nature of the business is a major strength. As we discussed, they tend to gain market share when consumers tighten their belts.
We saw that during the pandemic and the inflation shock.
Absolutely. The model proved incredibly robust through those crises. Demand for value soared.
And it's interesting what you said about their future strategy, focusing on the basics first.
Yeah, that shows discipline, I think. The Back to Basics plan is phase 1 and 2. Only in phase 3, after they've stabilized the core operation and got LFLs growing again.
Then they'll look at the bigger strategic questions.
Exactly. Then they'll properly investigate the case for a bigger push into e-commerce, maybe loyalty programs, expanding private label ranges further. They're resisting the urge to chase shiny new things before fixing the foundations. First things first.
Smart. Okay, so we have the potential, the cash flow, the growth plan, but also the recent operational stumbles and the execution risk. Which brings us perfectly to the final segment, segment 6. Valuation insights. Was the stock really a bargain? Why the massive disconnect?
Right. The core investment thesis presented in the sources hinges on this. The market severely overreacted to the recent challenges.
How much of an overreaction?
Well, the share price dropped by almost 50% in the year leading up to March 2025. But over that same period, the consensus earnings forecast only declined by about 6.3%.
Wow. A 50% share price fall for a 6% earnings dip. That does seem disproportionate.
Hugely disproportionate. It created the opportunity. The market wasn't pricing in a temporary operational slip and some CEO churn. It was pricing in something fundamentally broken, which the evidence didn't really support.
And those valuation metrics you quoted earlier reflected that pessimism.
Absolutely. Trading on a forward PE of just 7.7x, and an EV/EBITDA multiple of only 5.5x based on the pre-Jegan update numbers.
How does that stack up internationally?
It was a significant discount, not just to its own history, but also compared to its main U.S. peers like Dollar General, Dollar Tree, or Canada's Dollarama.
Even though B&M arguably had better growth prospects and returns.
In many cases, yes. B&M generally has higher growth rates and superior returns on capital than many of those North American peers. Part of it might be a general UK market discount, but the company-specific factors, the CEO churn, the LFL miss, really hammered the valuation down.
So the analysis tried to quantify that undervaluation using DCF.
Yeah, discounted cash flow analysis. And the sources used deliberately conservative assumptions to see what floor value it suggested.
What kind of assumption?
The baseline scenario assumed only 5% annual growth for the next 10 years.
Only 5%. When we know just the store expansion plan should drive 4 or 5% growth on its own.
Exactly. So that 5% assumption basically implies almost zero recovery in like-for-like sales growth. It's a pretty low bar.
Okay, so even with that cautious 5% growth outlook, what did the model show?
The results were really striking. If you assumed you bought the stock near its lows around £2.74,
Yeah.
the implied internal rate of return, IRR, on that investment based on the projected cash flows was 18.4%.
18.4% IRR. That's a fantastic potential return, especially for a stable, cash-generative business.
It's a kind of return that really compounds wealth over the long term. It suggested the market was demanding an extremely high return for taking on what seemed like manageable risks.
And if you flip the DCF around to calculate a fair value price,
the potential upside looked massive. Using a standard 8% discount rate, pretty reasonable for a company like this. The implied fair value was £9.01 per share.
£9. Compared to a trading price of £2.74. That's over 200% upside potential.
Over 228%, yeah. Now, DCF is sensitive to assumptions, but that's a huge gap.
What if you used a much higher discount rate demanding a higher return due to the risks?
Even being very cautious, using a high 15% discount rate, the implied value was still £3.58 per share.
Still over 30% higher than where it was trading.
Exactly. So whichever way you cut it conservatively, the analysis suggested significant undervaluation. The market seemed fixated on the short-term operational noise and the CEO changes.
It was basically ignoring the decades of proven cash compounding, the strong balance sheet, the high returns on capital, and that huge defined growth runway based on a successful capital-light model.
That's the thesis in a nutshell. The market focused on the execution risk, which is real, but ignored the underlying economic moat and the clear path to potentially 1,200 UK stores plus international growth.
So if the new CEO successfully executes that back-to-basics recovery plan,
then that valuation discount should logically close over time as confidence returns and earnings stabilize and grow again.
Okay, let's try and wrap this up then. Summarize the core tension here.
All right. On one hand, you have B&M, a business with a genuinely robust economic moat. It's built on scale, relentless low-cost operations, and that resilient counter-cyclical sales mix.
Plus a clear, very large, and importantly, capital-light growth runway. The plan for 1,200 UK stores, plus France and Heron Foods, is well-defined and self-funding.
But on the other hand, you have undeniable near-term execution risk. The recent managerial instability, the acknowledged operational drift that hurt those crucial like-for-like sales, that's the headwind.
So success really boils down to one thing now.
Pretty much. It hinges squarely on Jegan and his team successfully implementing that back-to-B&M basics plan.
Fixing the fundamentals: price, availability, range, promotions.
If they can do that quickly and effectively, restore discipline, and get the core UK business back to sustainable positive LFL growth,
then the underlying strengths, the compounding effect of store expansion, the high returns on capital, should reassert themselves, stabilize profits, and hopefully unlock that value the market wasn't seeing.
it looks like a solvable problem of retail discipline, of execution, not a fundamentally broken business model. That's
Right.
the opportunity.
Which leads us nicely into our final provocative thought for you, the listener, to mull over.
Okay.
We've seen that the most successful discount retail models globally, think Dollar Tree, Dollar General in the US, rely on relentless, almost monotonous operational simplicity and focus, day in, day out execution.
Discipline is key.
Now, B&M's new CEO has explicitly admitted that their own operations had drifted, become too complex, and that they need to go back to basics. So here's the question. Can any high-growth retail operation, especially in discount, sustainably resist that kind of operational complexity creep over the very long term? Or is this process drifting away from simplicity and then having to consciously force a back-to-basics reset actually an inherent, maybe even cyclical part of the discount retail business model itself?
Yeah.
Is getting back to basics something they'll inevitably have to do again in another 5 or 10 years?
That's a great question. Is complexity drift inevitable in growth?
Something for you to think about as you watch how B&M performs over the coming quarters and years.